Hey everyone, welcome to another video. Today we're going to get into trading cryptocurrencies, indices, and metals. We're largely going to go over cryptos because that was what this video topic was about specifically, because this is a requested video, but we are going to go over the same idea because the reality is that gold, indices, and cryptos, although trade with different levels of aggression and volume, they are all long-term appreciating assets, at least was what is mostly accepted, right? That's the mostly accepted response to that, right? Now, forex pairs, they are, although you have one currency versus another currency, and one can be largely appreciating in the short term or medium to long term, the reality is that they're ranging markets, right? So the market's usually going to be more ranging, and you're taking trade opportunities from different time frames, whether for continuations on a 4 hour, daily, you know, or hourly, whatever time frame you're looking at. But the idea here is that we are focusing on long-term appreciating assets, how to trade them, when to take buys and when to avoid selling, how to take sells and when to avoid the buys, right? So I've drawn a couple graphs here, and we want to go over the basic idea of what we're looking at when we're taking a look at these charts. So mostly the reason why these charts are drawn in this direction instead of versus as if they were pushing downward and then exploding up is because most of the time we are trending upward in indices, cryptocurrencies, and gold. And since we are usually on the upward trend, this is usually what price looks like before you want to say if you are going to go short or whether you're going to look for buys, right? And so in this case, we're going to look at an example where basically demand is stronger than supply. So if we're pushing upwards, let's just pretend that down here we have a higher low, right? Then we have a higher high, then we have a higher low, then we have a new higher high, and then what do we have? A higher low. This low is higher than this low. So you can see that we're pushing upwards. Once we fail to make a new high, right, what we could see is short-term or lower time frame ranging markets. This is what it could look like, right? But on the higher time frame, what you usually will see is when we fail to make highs, we start to make lows, right? Or when we fail to make lows, we're starting to make highs, right? So in this case, we failed to make a new high, and therefore we're probably ranging on a lower time frame. This is something that it looks like. Now, if we're going to go short, usually what you'll see is some formation of liquidity. We usually see a sweep of the highs, then a sweep of the lows, and then what we do is we mitigate the initial reaction that took liquidity. So in this case, if we're going to go short, right, what are we looking for? To make it simple or simplify it, we take the highs, we take the lows, then we mitigate. And that's what's happening in here. On a lower time frame, this and this can be seen somewhere in here. And then what happens is we're going short, and we've come down to a demand. Previously, before we tapped into this demand, which let's just say price was doing something like this. And that's why this is a demand zone, because this was a previous extreme low, right? So this is a higher low, another higher low, a higher low, and at this point we've changed directions, we've swept liquidity, we've taken liquidity from the downside, so we take the high, we take the low, we mitigate, and now supply is in control until we respect demand. Once we've come into a demand zone like this, what can we expect is happening? Well, at this point, demand is trying to hold this area, and price is basically showing us that we currently do not have enough volume to take the demand. And so usually you'll see demand just holding. Basically now we're making on the lower time frame what it looks like higher high and higher lows, which is like a continuation of this move, right? When we see the demand hold, we can expect what? That the supply is going to fail because the supply was too weak to take the demand, Therefore, the demand is going to be probably stronger and be able to take this level. And what this would look like on a lower time frame could be something like this, a variation of this. So usually we see some formation of liquidity, we see a sweep, we take the lows, in this case now we take the highs, another take of liquidity. This shows us the bullish intention of the market because we get an explosion upward of momentum and volume as we sweep the lows. And then what do we get? A mitigation. Same as here, right? Formation of relatively equal highs or lows. What do? We sweep the highs and then we create a reaction of high volume and momentum to push price away from that zone. We now see that in this case we have bearish intention, and that's when we come back to mitigate and we continue. So same thing. On this zone, what we're seeing is something like this. Once we see that, you can see that price is going to go long and it's going to take out this high. And so in this case, we are looking, when we can see demands holding, we're looking for buys. And we're looking for buys usually after something like this occurs, right? Now in the case, the opposite of that, when we see that supply is in control and demand is weak, we're going to see that demand fails. We're going to see the supply is strong and succeeds in taking out that demand. So usually most setups, as we are trading appreciating assets, this is what you're going to be looking for. The majority of your opportunities are going to be buys. They're going to be demands. Demand holding, taking supply, and continuing, going to create this same exact move. When you start to see this happening, this is when you want to pay attention, because this could be either just a sweep of liquidity or a continuation and a shift from bullish to bearish momentum. And this will be where you get very strong trades because there's a lot of fear and greed that pushes price downward in bearish markets or bearish momentum. So in this case, what do we see? Same thing as this, pretty much. Let's just say we see price going long. It's the same idea because we're long-term appreciating. So price is going bullish. What do we have again? We failed to make a new high with this one, right? We still have higher lows, but we have a failed to make a higher high. And what do we get? Price pushes down very aggressively. At this moment, supply is in control as we take out one level, two levels. As we start taking away the higher lows, supply is in control. And what do? We just push through and take out this demand. Therefore, demand failed. Now that we can see that the initial demand that created a new high, because previous to this, this was a higher high, then we have a higher low, then we have a higher high. When this fails, we can now bet that we are switching to bearish momentum, and volume and momentum will follow in this direction. And therefore, what are we looking for? We're looking once again for a mitigation now of this supply. And that's when we want to take the continuation. And the continuation will always be much more aggressive. Usually you can see price crawl itself back up here or push and be very corrective with its structure until we tap the supply, and that's when you usually see that we take out this low again. And then we're continuing the same move down. It would basically look like something like this. And you just see that repeat and repeat until, what do we see? Momentum switches, and then now we have bullish momentum and volume in control again. Now here, how does this apply here? You will still see the same thing. Usually you will see on a lower time frame, we have a ranging market. Then we basically creating equal lows or equal highs. We will see in this case a sweep of the highs. We will see price react to that sweep with momentum and volume pushing price down to take out the lows that just created that new high. And this will show us the intention of the market, that is heavily with heavy volume and heavy momentum. We are starting to push downward. Then what do we get? A mitigation. So we take the high, we take the low, we mitigate, continue. In this case, the demand, we take the low, we take the high, we mitigate and continue. So that's kind of the idea we're going to go over here. Now, this is something I wrote because we're going to look at 4-hour time frames and 15-minute time frames. And the reason why I wanted to look at those is because no matter what it is and your time availability for trading, if you want to trade and you have a full-time job, or you want to trade and you have several more hours than somebody else does, your time frame that you choose is going to be very important. And so you usually want to stick with one or use a couple in combination for your style of trading. If we focus on the 4-hour, and we're going to go over this, you're going to see examples of this, but if you only use the 4-hour, you will most definitely have a higher win rate. It's going to be much more easy to identify 4-hour zones. And because of that, they're going to be safer. They're going to hold a lot stronger. The only thing is you're going to have to be patient because you will not find trade opportunities very often. It could take a while before price comes back to mitigate an area that gives you a buy or a sell opportunity. When we trade the 15-minute, you will have much more opportunities to trade. You can have several per day, right? The other thing will be easier to scale. A lot of times, the same way that, let's say on a 4-hour, this might not be clear if this was 4-hour, you would see on the 15-minute this formation occurring. And therefore, you'd be able to narrow your stop losses and better target 4-hour zones, even if you use the 15-minute to refine it, to catch opportunities to get in like this. Now, I trade this style on the sub 1 minute time frame, but on the 15-minute, you will see these all day long. The one thing is that you could oftentimes get missed. Sometimes you'll see that price will come in and just slightly miss your zone, and it could have just mitigated a different time frame, a 4-hour zone, and it just never came into your 15-minute. So you will oftentimes find that you could potentially miss trades, but one of the best things about 15-minute trading is that it'll be much faster for you to find out if you're in a winner or a loser, and that's because usually these trades don't last so long. So you'll find out within a couple hours that your trade is hit stop loss and you're wrong. So look for the next opportunity, right? Much more opportunities to get in. So I hope that this makes sense. Now, when we're trading ranging markets, we're not going to go over too much into that. But what you are looking for in this case is, again, something like this, right? On the lows, what are you looking for? When we are coming into demand, if demand is going to hold, you're going to see that it doesn't get violated. You're going to see that formation of equal lows in here in this zone. You're going to see a sweep. We're going to take the low, take the high, mitigate, continue, right? And what are you targeting? The supply, because what? The supply has also been holding. When supply holds, what are we looking for? Same thing. Formation of liquidity. We're going to take the high, we're going to take the low, mitigate, continue, and we're going to target what? The demand zone. And you're going to see price basically ping pong back and forth. So this is going to change the way you look at the markets. Basically, it's change of character, but in this case, these are also important because they sweep liquidity. And that's basically what makes these so important to look for. So let's get into it. The first thing I wanted to show you was the gold chart, just to show you extreme levels. So we're going to be on the daily. This is what I wanted you to take a look at. So no matter what time frame you choose to trade, one thing that you're going to notice is that price is always trading to and from a certain zone on the higher time frame. It doesn't always come exactly to tap the area like you think, but more often than not, if you wait with patience for price to come into your level, you will almost always find that trade opportunity. For example, let's take a look at the daily. So this is gold. We're only going to look at since, let's say, July 2020 to today, which gives us quite a bit of time. You can see that this was a previous extreme. This was the demand zone. This was the initial push down before we had this massive pushed up that made all-time highs, right? Previous to this, we were still making all-time highs, but at this moment, this is where we had the highest high, and this is our, let's say, our higher low, right? What do we have? We have a supply zone here, on the daily time frame, all I'm doing is I'm marking out basically the last candle or so, basically the highest candle before we have massive momentum enter the market, creating an engulfing candle. So usually it's like a buy to sell or a sell to buy, and I like to highlight the candle just before. This is an order block idea. You can find more videos on order blocks somewhere else. I'll maybe make some videos on that, but the idea behind this is usually I'm looking for the last buy candle before an engulfing sell, or I'm looking for the last, let's say, sell candle before an engulfing buy. And the idea is that they have to take liquidity, they have to take the high, they have to take the low from whatever else you're trading. So previous to this, we have this supply zone that just never got tapped. So we're just going to delete that one. But everyone else other than that did get tapped that we're going to go over. So basically we have this high that makes this push low. It's a long wick. What do we get? Price pushes back up. What do we have? A buy to sell. You can see this is a buy candle before an engulfing sell candle, right? And this is because there's a lot of momentum injected into the market here. We can expect what? We can expect price to hold this level. Unlikely that we are going to take all the liquidity just formed on all the liquidity injected into the market for this push down, because you can see that we are now going to switch bearish. And this also tells us there's no reason for price to take out this level, because now the volume and the momentum is now in, let's say, favoring bearish intentions, right? So what do we get? We get price to come back, mitigate, tap the daily buy to sell candle. So what do we have here? Look at this on the daily time frame again. This is the last buy candle before we have an engulfing sell. An engulfing sell, engulfing refers to that this candle basically is a massive candle, and this big candle closes with most of the body closed, and it takes out a previous level. So in this case, price was pushing up. So in this case, we have a buy here, we have a buy here. This engulfing candle takes out 1, 2 buys, right? And pushes down, still respects this level, but we take out these 2 levels, these 2 candles with this buy. Then what do we have? Push price lower. From here, what do we have? We now know that part of this leg on a lower time frame is from here to here. So we're expecting price to come back and respect this 4-hour buy to sell. So price pushes up. What do we get? Price comes into this 4-hour level, respects, does not violate and take this high. What do we have? Price pushes back down aggressively. This one sweeps liquidity from the downside. So price from here was pushing upward into the zone. We get a reaction from this zone that takes liquidity from the initial candles that pushed it up. And then what do we have? The formation of another order block on a lower time frame, this one, from here to here. But we wanted to take the, let's say, the push down alongside with it. So this was the initial reaction from here to here. So we're highlighting these 2 candles. This is basically a sell or a buy to sell, and this is where we have the injection of momentum that finally creates an engulfing candle. So in this case, what do we get? Price, this case, this level took out this low. So we have extremes, right? So this was the extreme from this leg, but from this leg we have this extreme, for this low and this high. Previous to this, all of these pushes downward still respected and held this level. So only after this supply zone did we take the liquidity and create a new low. Because this created a new low, we confirmed bearish structures forming, and we expect that this level holds. So as price pushes up very correctively, creating a lot of liquidity to take for the downside, when price finally comes into the zone, what do we have? It respects the supply level. So the supply level holds, and what are we going to assume? We're going to continue bearish momentum. And now what are we targeting? The new low that recently formed. So this will be a new target for us. And so In this case, when we respect the supply, what are we doing? We're targeting the demands because the demands are not going to hold. So on the lower time frame specifically, they're all demand zones in this area. Now while we have higher time frame demand zones like the daily that are already drawn on the chart, on every leg that we have, there's always a demand and there's always a supply. Demand, supply, demand, supply, demand, supply, supply, demand, demand, supply, demand, supply. You have to look at it from those extremes. So to every leg formation, there's going to be a supply at the top, there's going to be demand at the bottom, and we are waiting to see which one gets taken, because then we are waiting patiently for a mitigation of the level that is a stronger one that took out the opposing side. So when the supply holds, we're taking out demand. When the demand holds, we're taking out supply, right? In this case, because we're largely bearish on the daily time frame, you're just going to see supply constantly holding, right? Once we take out this level, this low, we even took out this daily demand level, we are very much showing very strong bearish intentions, this leg from this supply to this demand. We are now expecting continuously supply to hold and now targeting this demand. Therefore, what do we want? We would take another entry here in this zone on a lower time frame, or you can just highlight the entire zone and then we would target here. So if we were taking buys from each one of these mitigations, this is what it would look like. We would take the entire supply zone and we would target basically the elimination of the demand zone. So this is one that would continue. It didn't hit stop loss. So from this supply, came down, took it out, right? So I'm just going to close it a little bit like that so it's a little bit easier to see. Then this is a supply zone that came down, pushed, took out the initial push up. What do we have here? Here we have a supply zone that holds once again. What are we targeting? Same level. We're targeting the elimination of this demand zone. Same thing here. What are we targeting? We have a new demand, a new low, which has a demand zone that we are expecting to eliminate. So what are we going to do? We're targeting that level. And the reason why I'm going over this on gold is because the chart trades largely the same. The difference is it's going to be more clear with less aggression than cryptocurrencies will. And we're doing the same thing each time. So for example, entry 1 was a 2.8R. So here for every dollar you trade, you're going to make $2.80. This is a 3.5R, right? Hits take profit, breaks low. Now we're waiting for what? We're waiting for price to come back to mitigate another supply for another re-entry. What do we have here? This is a 2R trade. Price comes down, takes out this level. Now, could you move your targets to trade to higher time frame zones? Absolutely. But in this case, all we're looking for my examples is that we're taking out the opposing side, right? Now that we took the opposing side, we're waiting for price to come back into what? Our supply zone for a re-entry. This is a 5.89R, almost 6R out of this one. What are we waiting for? To take out this demand. Price does it, right? Now what do we have? Price continuing downward. We have formation of equal lows. We're forming liquidity here for the future potentially. What do we have? Price continues to rally back up. What are we looking for? Well, in this case, and this is a new concept that, I'll introduce in another video. This is other people already know. A lot of people already know about decisionals versus extremes. In this case, price did not come to the very extreme of the supply, but it came to a decisional level. This is where we see price pause for a moment on a lower time frame is creating a range, right, as I showed you in the previous example. And what do we have? This is where price decided to commit to going bearish. So this is where we had the injection of momentum and volume into the market, and this is where we get the initial push down that creates that break. Notice how in all these other cases we have an engulfing candle from the initial extreme supply. Very strong engulfing from the extreme from the extreme. In this case, we have an engulfing candle, but we have a pause. That pause creates a decisional opportunity to get in. This is where price decided to commit bearish. This is where we get a re-entry, right? Here we would have had another entry. What are we targeting in this case? We are targeting once again, let's say, the failure of demand. Demand in this case maybe takes you out, not takes you out, maybe maybe hits your take profit. Maybe it's still considered it respects demand, but take a look at this. This is a 10.8 hour trade. Comes down, makes equal lows. Now we have 1, 2, 3 equal lows. Now where's our current supply? This level right here. So now what are we looking for? Continuation. Potential opportunity here. Right? What are we looking for? What's the most recent demand? This is the most recent demand that pushed price up, because we have demand held here. Demand is holding here, even though it's creating equal lows. This is a new demand, right? So this entire wick can be considered our daily demand. This respects demand, and we get a push up that takes liquidity from 1, 2, 3 equal highs. So this is a new demand that is pretty strong because it took out these levels. But will it take the let's say the external liquidity from up here? Probably not. So what do we expect from this low to this high? Price respects, and we're trading back into demand, and we're just expecting price to continue here. Now, could price continue to push up, create another opportunity for an entry, and then come down? Yes, we've seen that happen multiple times. So we could potentially take a short from here back to demand. And so this is just showing you how price is just building up on itself, giving you multiple opportunities to enter. When we have a smooth trending market, it's a lot easier to spot it. Now we're going to go over specifically examples on Bitcoin and Ethereum. So I have several examples for Bitcoin and Ethereum. Hopefully these are pretty easy for you to grasp. Once again, I'm just going to show you a peek at this once more. The link will be in the description to YouTube. What are we looking for? We're looking for demand to hold strong and take out supply, or we're looking for demand to fail and to have a strong supply that we come back to mitigate for re-entry. We're looking for this on a lower time frame, creation of equal lows or highs relatively. Then we're taking to take the high, take the low, mitigate and continue, or we're going to take the low, take the high, mitigate and continue, right? That's what we're looking for. Let's take a look at example 1. Example 1 will be, let's get rid of these things here. 1 4 hour, that will be all the way over here. So we're going to use the 4 hour. Well, on the daily time frame, I just wanted to show you really quickly. Might as well. I have this daily supply demand ranges. Let's see, where is this coming from here? All right, so on the daily time frame for Bitcoin, what do we have? Same kind of concept as the gold. It's just not going to be as clear because this is a more aggressive market most recently. But you can see demand holds, right? This is creating a new demand. Price pushes up, comes back down, sell to buy, creates a new demand. Demand holds, we get a sweep, but we continue long. What do we have? A new demand here. This demand holds, gives us a reaction. Once we start failing and breaking demand zones, what do we have? Potential supply zones. You can see in this case, these didn't hold, but we're going to show you why they didn't and how to take trades off of levels like this. And in this case, because it's a largely appreciating asset, we can expect to make new highs. So supplies are going to usually, in general, always be weaker, right? Depending on the time frame. But you can see how price has respected demand, came in, tapped. After it tapped this daily demand, look at how much progress we made from here. We created new all-time highs. Price pulled back, continued, new all-time high. Now it's been dropping down to what? Tapped this demand, reacted, left behind a big wick. This is a how many thousands of? This is almost $7,000 in one wick of points, right? Price pulled back up, respected the demand, and now what do we have? We formed a new demand. This one was violated, and now we broke 1, 2 levels. So now we're bearish until what? Until we probably come back into what? This demand or this demand. And so price is just ping-ponging back and forth from these levels. So let's get into it. We're going to look at example 1 all the way over here on the 4-hour. So remember the diagrams. So this is a daily demand zone, is the idea behind it. What I wanted to show you here is market structure, how it's developing, and when we get our change of character, which is the move that we're kind of looking for. So in this case, we have this large wick creates a demand. This is the source for this push up that creates this new high, right? So this wick is very important. We're expecting, if we're going to continue long, demand to hold. Now, whether it's the daily level or whether you refine it, whatever it is that you're going to do, it doesn't matter. That demand has to hold on a higher time frame if we're going to continue. So we make this new high. What do we have? From this high, we get a new leg pushed down. This leg pushed down, it also respects this level on a 4-hour level. So what do we have? This respects the 4-hour. Could you have taken a buy from here? Absolutely, right? But we're not going to focus on that yet. You get what? From here, we respect the daily demand, so we're expecting to make new highs. But in this case, we failed to make a new high. Therefore, we're going to push lower to find a place where we can get more demand, because clearly this was not enough demand in this zone to create a new high. Therefore, we have to search lower. Now we can do so while still respecting demand, meaning we can be bearish going into a demand zone. As long as that demand zone holds, we will have continuation long, right? So what do we have here? Price pushes down. We have 1, 2 relatively equal highs, right? So that's formation of liquidity that we might take later. This is a high that creates a new leg down. So what we have here is this is a supply zone that creates a new low into this higher time frame demand zone, right? So this supply is a 4-hour supply that created a 4-hour leg down that's respecting and holding the daily demand. So now what we're looking for is one of two things. We're either looking for demand to basically, or this supply, we're looking for supply to be respected, and we're looking for a mitigation to take price lower, or we're looking for this level to be violated and then have continuation long, right? So that's something we're looking for. What do we have? We made a new low, price pushes up. We have this substructure here is developing a lower high, right? So high, lower high, lower high, lower high. Now what do we have here? In this moment, we failed to make a new low. And while you wouldn't just notice when price stops here and comes back up to here, you'd be like, oh, we failed to make a new low. No, price could still continue to go lower, but it's when we take out the high that we start to pay attention to this, right? So this was a previous lower high. And when we take out this level, and we are now showing some bullish intentions of the market, because we failed to make a new low and we took out a previous high. And in this case, not just one, but you can see how price paused here in this market, paused here, created a flip zone, as I show in my other videos. So we had a buy here to sell, where we have price comes in, taps the supply here on a lower time frame. Even though the supply didn't make a new low, it's still a supply zone because price did push and take liquidity down here, right? We came to respect this level. So on a 4-hour, we could say that this wick is a demand zone. So this demand is holding. And what do? We take out one high, we take out two highs, and we take out these equal highs, 1, 2 equal highs. So at this moment, we now have the impression that we are holding this daily demand zone, and we are more than likely now switching from making lower highs and lower lows to higher highs and higher lows. So this is the initial area where we had that reaction. Price pushed down, took some internal liquidity in here on a lower time frame, and this is where we had the sell to buy. This sell to buy was engulfing. Look at how much momentum and volume pushed into the market at this moment that created this massive sweep to the upside. At that moment, we can now expect that because this is where the buys came in the market and we have a valid flip, that this is a beautiful place to enter with a new a buy to continue long, because this is now going to hold and we don't have a reason to come back down here because this is where we injected momentum and volume, right? So in this case, now what we could do is we could go on a lower time frame. Let's go to the 15-minute because we want to potentially refine entries. In this case, we don't have to, but we could. If we go to a 15-minute, look at how clear the view here is. You can see exactly where momentum was injected into the market. So at this moment, price came in, reacted to the supply zone. It pushed down. This took liquidity that pushed price initially up into the zone. Very corrective push up manufacturer liquidity. We took some of that liquidity. And then here we have a buy, a sell, and then an engulfing buy. So now what are we looking for? We're looking to basically respect this demand. So this 15-minute demand zone is basically where price injected with high volume and momentum into the market. So this is the area where I'm looking to respect, to mitigate, and to buy. So if you remember the graph that I showed you before, what are we looking for? We're looking for, in this case, demand to hold. We swept, we took equal highs up here. Now we're looking for a mitigation and continuation. So here price came in. You can see that it respected demand. It did not violate. And therefore we could take a refined entry from this 15-minute. Here we got confirmation. So on the 15-minute, we look bearish going into this mitigation. Price came in here. It pushed up, swept this high, showed us more bullish intention, came back. This is where we got our re-entry. You could have just entered anywhere along here. And then what do we have? Now that we are targeting to continue long, our target is what? Well, we're expecting price to continue long, and therefore we are targeting the highs. Because if demand is holding, we are targeting the opposing, and in this case the supply level all the way up here, wherever it is, like this, we're basically expecting this level to go. And this would be a, how many R trade? About a 15.5 R trade. And you can see what happens. Boom. We took profit just at this level. We took out the high. We're done, right? Example number one. So once again, we're looking for price to fail to make new lows in this case, to take out the high, to sweep liquidity. We're looking for where price injected momentum into the market, and we're looking for price to come back, mitigate, and respect that level, and we're targeting a higher time frame zone. Now, if you were trading just based off the 4-hour, your trade wouldn't have been a bad trade, would have been a good trade, but it would have been about 1 to 4, right? So would you want to have a 1 to 4, or you could refine and have a 1 to 15, right? All we did was we took out a 4-hour zone. Once we saw price explode from here, we're like, all right, well, let's find out where it came from. Go down to the 15-minute, and that's how we got it. We just went down. It was very obvious where price came in and injected all that momentum. That's where we got in. So that's example 1. Let's look at example 2. We're going to go to, that would be up here. So let's go here, right here. Just want to verify. All right. So I think we only need to look at up until here. So on the 4-hour time frame, what are we looking at? Now that we had buy showing us that it's in control and we're going long, what are we looking for? We're looking for 4-hour demand to hold. So this is a daily level. We don't need that daily level because we've refined down to the 4-hour. So here we have a sell to buy. This is kind of just like the 15-minute, except we have very aggressive push from here. This is a pause. We decided to continue. This could be a decisional, right? Price came in to tap this zone, and it's holding. Just because it comes in to tap doesn't mean it's not going to continue to hold. It can come in to tap multiple times, 1, 2, 3 times in this case. A lot of times, as long as the area holds, you will have continuation. So in this case, what are we looking for? We're looking for, in this case, demand to hold, and we're looking for the lows to not be taken out. So in this case, what do? I take this little tool and I just draw out wherever I see a low that creates a new high. So we have, let's draw this out basically. We have from here, push low. This low creates a new high, right? We have a push down here. We're creating liquidity. Price creates a new high, comes back down. This basically works as a sweep, and it mitigates something in here, right? So this is a 4-hour zone. Price continues long. This is a pretty big leg. Pauses, creates a range on a lower time frame. This is a low. This low holds, pushes up, and then we have price kind of showing us some bearish intentions up in here. When we see this massive wick to the downside that takes out this level that pushed to make this new high, so price from this low to this high to have a higher low and then a higher high. Instead of getting a higher low that respects this level, we swept it. Now, we also continued to make a new higher high. We saw the same thing in this case. We swept some liquidity in here. When we have equal lows, a lot of times that's going to be targeted, and what that will do is it will simply come back to target an unmitigated zone. So it could come into something here, or on a lower time frame, something that happened within here, right? So we won't always see it on just a one time frame. You'll have to sometimes clarify it. But when we saw this push down with this wick, we can kind of see that price either is weakening, or we could see that price needs to come back to buy, to get a better buy, for example, right? Because previous to this, we're just continuing going higher and higher, and we're doing, smaller mitigations in here on the lower time frame. But when we have this really impulsive leg up, and price has to sweep down to get more liquidity, to get more buys, because there wasn't enough buys here, you can bet that we could be seeing potentially price switch momentum. So in this case, what am I looking for? I'm going to go on a lower time frame to see what's going on. So here, this is the extreme. Let's take a look at what happens here on the 15-minute. And then let's put our 15-minute stuff on here. So we're going to see a sell opportunity on here. So here, what do we have? We have this low, new high. We have formation of equal highs. So even when price pushes down and takes liquidity and sweeps down this level, we still know that we have some liquidity up here that we need to take. If you remember that diagram I showed you, what do? We form equal highs and lows, right? Then we take the high, we take the low, and we mitigate. In this case, we're waiting to take this level before that happens, right? So on the 15-minute, what do we see? Look at this sell to buy. This is where price injected tons of volume and momentum into the market. Kind of in the previous two examples, we could see this depending on the time frame. You also get it here. What do you get? Price reacts to this level, pushes back up, relatively equal highs, same thing. This area is a strong demand, and the reason it's a strong demand is because it took the high, made a new high, and in this case, it also swept this liquidity. So this liquidity was liquidated, and now what do we have? We have a strong demand here, and now we have multiple lower time frame levels here that are lows that will create new highs, right? So this is a low, price pushes up. What do we have in mitigation of this demand? Price continues push up. We're still waiting to make a new high. We don't make a new high until we take out this level, right? Price, another low. Price pushes up. This is higher than this one. Price pulls down, pushes up. Equal highs. Then what do we have? Price creates a low, and this low is where we get an injection of momentum into the market. This is a demand. Let's label that demand. We have a new high, an all-time high in this case. And then what do we have? Price pushes down. Instead of just respecting this level, we react and then we take it out. And at this moment, now we take out this level on a 15-minute time frame. Well, we're taking out levels on 15-minute time frames all the time, right? But we're taking out the level that created a new high. But at the same time, we're taking one level, right? We react, we push back up, and then this is a buy to sell. Look at this engulfing candle down that takes out what? Another level, 1, 2, and 3, that takes out this initial strong demand that previously broke structure to the upside and swept liquidity. So we're noticing now what? I hope this isn't too confusing, but the idea we're looking for is now we're seeing that demand is failing and supply is holding. We took out one level here, 2, 3, 4, 5 levels with this leg down like this. So what was the one responsible for taking out the strong demand? It was this area here, this leg push down. And so what do we have? We're going to just highlight this entire 15-minute zone. This is a sell to buy. This is a buy to sell. This is where we have price ranging in this level, an injection of momentum that pushes down. But here we did get a reaction. So, on a lower time frame, this is what this looks like. Reaction. We're basically showing bearish intentions into the market. Then we sweep, come back up. We have a buy to a sell. That's a strong sell. So we're looking for a mitigation and continuation. So in this case, what do we get? We have an entry at this entire zone because this level broke structure to the downside and made this demand fail, even though it was a strong demand. This is one leg in this case. We can expect that this area will not be breached. This is protected. So we will take a buy, or a sell, sorry, from this level. Price comes in, taps, gives us our entry, respects that level. And what are we targeting? We're targeting the 4-hour demand that was responsible for this leg up. So we're going to take 1, 2, 3 levels, in this case to the downside. And this would be a 19.19R, almost 20R. And the idea here is, you could trade just until the 15-minute demand goes. But when we are trading like this, we like to trade with the higher time frame because you can see on the 4-hour the price is trending bearish or bullish for a pretty long time. Usually it will keep its trend. And so when we're using the lower time frame, we're simply using it to get a refined entry, a better quality entry, where we can trade towards the higher time frame intentions, right? So that's how we got this entry, right? We reacted to demand, but we failed. We broke demand 1, 2, 3, 4, 5 levels. We broke a strong demand that was responsible for a new high that swept liquidity. And at that moment, we took the area that broke that demand as a strong supply, and that's where we entered for a mitigation. So that's number 2. Let's look for setup number 3. And it's the same kind of thing over and over again, right? It's constantly repeating the same steps, which is why it shouldn't be so complicated. And hopefully each one of these examples clarifies it for you. All right, so here what do we have? I'm going to show you a couple opportunities here. So whether you're pro trend or counter trend, there will be multiple opportunities to get into the market. As long as you're targeting properly, you should have a good win rate, right? All the way to your take profit. So in this case, what do we have? This is a demand. We have a pretty strong wick here. This is a daily demand. If we refine it to a 4-hour, this is what it looks like. Price pushes up. What do we have? Price in here mitigates. Instead of creating a new low, we fail to make a new low. And what do we make? We make a higher low and then a higher high, right? This area's higher high territory, but this is the higher high, and this area takes out this liquidity here. So what can we bet? Now that we failed to make a new low after we mitigated a supply zone, because this is all supply that created a new low, but also respected some demand in here. So demand here is in control. This was the supply. This supply took out this level, which is the lower low I'm referring to, right? This demand held, so this is demand zone. Price reacted, pushed up, came back, mitigated, and swept this reaction, but still respected the overall demand. And when I see that this pushed up and came up this high, this is one leg. Therefore, what I'm expecting is if I'm not going to, if I didn't take out the demand, I'm going to be respecting it. Therefore, I would be looking for price to come back into demand and go long, right? Now, we didn't get that. Price did not come back to mitigate this zone, but it created a new zone. So this is a new leg from this high to this low. We created a new high, right? And therefore, when that happens, what can we expect? Come back to mitigate the area that created a new high. We create another high. When price takes that old high out, what can we expect? Price to come back to mitigate that level that created that new high and continue to make a new high. Now there'll be a time where it runs out and that doesn't happen again, and that's what this example will also show, right? In this case, what do we have? We have this demand, both responsible for creating new highs. So this is a high that was taken out. This is a high that was taken out, and the origin of that is this one, and the origin of this one was this one. So this is one leg. So demand, supply, supply is being targeted, demand's holding. If we go on a lower time frame, let's say the 15-minute, we could refine our entries. So what we're doing is we're simply highlighting 4-hour areas, and then we are awaiting with patience for price to come into those zones. So here, what do we have? Here we have multiple areas that we could be highlighting on a 15-minute time frame. But the reason why we're highlighting this one is because this is where we have our original change of character and our extreme that's unmitigated. So previous to this, what do we have? Price is pushing down, making new lows. We are taking internal range liquidity, right? Some minor structures going, substructure, but we're still creating overall new lows from this high to this low. Now what do we have? Price pushes up, and in this case makes a new low, and this low takes out what? This initial reaction that was the push low. So we had this low, and this is a new low, and then another new low. This level was taken out by the reaction to the sweep here and created this high. So once we have this, we can get confirmation that we are probably going to switch long. Now, this happens several times all along here, and therefore we're not going to take the first, let's say, reaction here. We're going to wait with patience to see what this origin of this move results in, right? Now, when we see that this extreme basically creates the leg up that creates a new high, we can expect that this area should hold as demand. Therefore, we will highlight the entire 15-minute sell to buy that gave us a strong reaction that's unmitigated. We'll drag it across the screen, and then we'll await with patience for price to come into that zone. What do we get? Price comes into this zone, comes into taps the 4-hour, but this is the 15-minute we're waiting to enter. Pushes back up, reacts, pushes down, gives us our entry. This is entry 1. Price reacts aggressively to that 15-minute and takes out this high. So previous to that, this was the low. This was the lower high. This is a lower low. This lower low reacted to this 15-minute demand and took out this lower high. Now we have what? A higher high. Now we're expecting to have a higher low and a higher high. So this is how we took that entry. Now, what are we targeting? We took a 15-minute refined entry of the 4-hour, but we know we're bullish, so we're going to target what? The highest high of the 4-hour. And what happens? Price from here goes all the way and takes out this level. So now what do we have? What is the area of interest that created this leg, this 1 4-hour leg up? Right? Let's take a look. Right? So this leg, this is where we got a refined entry from here. Took out this high. Now that we know this high is taken out, what are we expecting? If price has to pull back to mitigate, what are we going to wait for? Price can come to the 4-hour zone, but if we refine it down, let's look for our 15-minute zone. Well, where was the extreme that created the shift in momentum from bearish to bullish? This one took liquidity, and then this is where we had an injection of momentum that came up that swept and took out the high. Therefore, this is an unmitigated 15-minute range, or it's a range, sell to buy, right? That this is where we're looking to buy from. Now, price came in here, you could have taken a buy here, but only until after we made the new high did we have a confirmation that we would protect this level, because previous to that we could fail to make a new high and then just take out that level. So what are we looking for? We're looking for price to come in and tap that range. Price comes in, taps, gives us our entry. Here we are, respects demand. What are we expecting? We're expecting the high to go. In this case, what do we have? Price pushes up and fails to make a new high. In this case, what we get is price turned back around and takes out this demand. And therefore, in this case, now demand fails, and now supply is in control. But before that happened, we had several buy opportunities just continuing to hold and create a demand chain. We have one entry here that was 8.3R, targeting the 4-hour high, using a 4-hour demand that was refined to the 15-minute. Then we had another 4-hour demand refined to the 15-minute. They gave us a 1 to 3.9, almost 4R, once again targeting the highs. Now in this case, what do we have? This one did fail to make a new high, but did give us some return on, some risk to reward on here. Still gave us 2.8 almost, right? And what do we have? Now we have confirmation that demand failed. More than likely, supply is now in control. So now we're looking for potential shorts. That's when we get the shift. Now let's take a look at another example. We're going to go to example 4 hour. Perfect. And we're going to use this area. This is a pretty good one because this is a range. So this will give you, this is going to look similar to like what the gold example I was showing you. So this is a demand that was holding on the daily time frame. So on the daily time frame, what do we have? This demand that created, this is the extreme for this leg all the way up, right? This demand, there's a supply here, supply failed, demand is holding. So look at how we respect this level. We did not liquidate this level at all. We just came in, respect, created equal lows, and continued going along. So we're going to look at that on the 4-hour. And I'm going to go back to here so that it's very clear. Okay, so what do we have here? We have a supply chain forming. So previous to this, what do we have? Price is very bearish and it's pushing down, creating new lows. Look at how strong and how impulsive this push down was. It just came down to create an almost exact equal low. You get prices pushing up, reacting to that level, showing some bullish intention, and then what do we have? Continuation to go short. So this is one leg down. What are we expecting? Well, each leg, let's draw it like this. Let me start with this like this. One here. We are expecting each leg to hold until one direction goes, and we're continuing to follow the direction that is targeted. So in this case, what do we have? From a high to a low, price pushes up, gives you the opportunity to get an entry here. You can take a short. Now what happens? If this low goes, we're continuing short into even though we are in a daily demand zone, we could continuously still be targeting this area. And so we could be looking or hunting for a deeper mitigation, right? So this is one leg, price respects. So what do we have here? Let's do this. Sorry, one here. So this is a high. What do we have? We're targeting the low. We got an entry from here. Once this low goes, we have confirmation. Now what do we have? We have two supply zones. We have this one that didn't get mitigated on this push down, and we have this one that is directly responsible for creating the break and structure to the downside. So in this case, we are setting an order here. So this is a supply that we want to take to what? To break this low. What happens? Price comes in, mitigates, respects supply, gives us another entry to what? To target the low. So from here, we break the low, we take it. Now what are we looking for? We're looking for price to come back into the zone to create a new low, right? Now in this case, we have the reversal. But before that reversal occurred, we had multiple opportunities for entries. Now in this case, you could target this zone, right, to be safe, but you could have also targeted this low to go. Considering that this buy was weak and did not create new highs after that, you can see that price is very correctively pushing downward because we need to come back to either take out this level or to react to something in this level that created this initial push up. So this is a weak level that's going to go, and that's why we had this. So let's see on here, I labeled them. Yep. So here, for example, these are your entries you would have gone. You would have had entry number 1 right here, like what? We're targeting to take out this low, a 1 to 3. Now if you adjust it to take out this level or to just equal lows to here, because obviously we had a this low, this high, reaction, pushed high. This didn't really take anything on the higher time frame, anything really high, and we had price pull back. So in this case, it reacted to this level. If we're expecting this low to, this supply to hold, we're going to continue downward, probably back until here, right? Then what do we have? Confirmation. We take out the low. Price is building up liquidity on the way up, comes back, taps this mitigation that is the supply responsible for breaking structure to the downside, comes back in, gives us another entry. So we have 5.8, 6.65, and in this case, when price comes into here, we probably took a loss on this one. You risk 1%, you lose 1%, but you still have two really good trades that played out properly. In this case, now what do we have? On the daily time frame, we have a new demand. Let's take a look at that. Let's show the rest of this one. Now I'm going to show you the 15-minute refine zone, but this is what that area looked like. And you see on the daily time frame, this demand is sell to buy. This is a supply that resulted in an engulfing sell that pushed price up all the way up here. So this is going to be an important level for the future, right? That's important to keep in mind. Now going back to where we currently were, I'm going to show you what happens when we refine our entries. And let's see, I think that's on the continuation long. Okay, so anyways, we're here. Once price pushes up, takes out this high, we get a change of character, because now what do we have? Confirmation. We have this high to this low to a new high. We have price pull back down aggressively. What do we create? This level here that results in a new high. Now, while many people would look for here for a buy, you just would have kept waiting with patience and you would have never gone an entry. And that's why it's important to pay attention to levels that specifically result in the break of structure. This is the extreme. This is the buy that results in the break of the high, creates a new high. Price pushes down. This is the buy that creates the break and the new high. In this case, we have this extreme that's unmitigated, and therefore this is a more attractive area than something in here. Considering that in this case we did mitigate this level, create this high, but this level is still unmitigated on a lower time frame, right? So let's see, on the 4-hour, what do we have? This demand zone, responsible for this one. Continues, we wait for price to come back down, taps, gives us, what are we targeting? A new high. Here we have 4.5R. Now what do we have in this case? On a daily time frame, this is a new demand zone that we could be looking at. Look at this. This is a new demand zone that we could be looking at in the future. Price does come in to tap it, and look at this, continues long. Price comes in, we've just tapped into it today, basically. And now what are we expecting? Well, if this this reaction created a new high, if this doesn't create a new high, this is going to go, we're going to have demand fail, and we're going to continue to what? To the next lowest demand zone. That's how it works. So let's go back to here. Let's look at 15 minutes. And let's see, because I have so many examples, I want to make sure that these are clear. Yep. Alright, so on the 4-hour, this is what it looks like. We have this demand, pushes, makes new high, pulls back, mitigates this level, pushes up, creates a new high. What do we have? Creation of relatively equal highs. We're forming liquidity, right? Price comes back, mitigates the 4-hour, takes off, new high. Relatively equal highs. Price comes back. This is the demand that creates a new high. Price comes in, taps, pushes up, continues, pushes deeper, mitigation, respects this level, takes off, creates a new high. And I'm going to show you how we refine these to the 15-minute. So 15-minute. So we have a 4-hour level, and if the level is pretty big and we want to refine our entries so that we can have more accuracy, this is how easy it can be. Let's see. Let me just turn the brightness up here. Alright, so the first light colored zone is the 4-hour, right? And the 15-minute is going to be the darker zone. So what do we have here? When price came down here and created this new high, so this is one leg from this low to this high, what do we have? The reaction from here that reacted to something here created a change of character. You can see how aggressive this push up was. This is a sell to buy. This buy is engulfing, and what does it do? It takes out the initial push down. So previous to this, we had from here, push down, up, this was the high, created a new low. This new low pushed and took out that the lower high. Therefore, we have a change of character, and when we get confirmation that we create a new high, this is now a valid level. We refine the 4-hour to the 15-minute, and when price comes down, what do we have? Price taps in and continues long, because what are we doing? We have overall bullish trend. And what are we targeting? We can target the equal high, right, to take it out, or we can continue and hold it until we find that price gives us the change in character to the downside, right? But for this example, I'm showing you the safest take profits are always going to be just to take out a level or create equal highs or equal lows, right? In this case, we get 3.4R. Then what do we have here? Look at this. On the 15-minute time frame, this is the 4-hour level, so all this right here for the next leg. So this is the 4-hour, and we refined it down to this. This is a sell to buy. This buy is engulfing and is responsible for taking and breaking structure. We do have a pause in the market here that we do get a reaction to that does create a new high here, but we only want to trade from the extremes because we want strong continuations. This level would have been able to get taken out. So we take from the extreme. In this case, this is our extreme unmitigated that is responsible for the break of structure to the upside. So we refine that and we look all the way to the right. When we get confirmation that this level creates a new high and breaks structure to the upside, we know it's a strong demand. So we've refined this entire 4-hour demand into this. Now what happens is price comes in, taps, we get a strong reaction to the upside. So in this case, what was the initial move that pushed down? This was the lower high that created a lower low. That lower low, this reaction took out this lower high. So now we have bullish intention flowing into the market. What do we have? Price continues down, right? And what do we have? A formation of a new unmitigated demand that will serve potentially for later use or not. But this is our entry, and this is 15.7 R with a $180 stop loss targeting minimum $2,900 dollars. So now, what do we have here? We targeted the high, and look, we get continuation. Now you could have done multiple things on here. For example, while we have a 1 to 3.4, 1 to 15.7, 1 to 19.9. Did I go over this one yet? Not yet. So let's go over that last one here. What do we have on the 15-minute? Once again, we have this unmitigated extreme. This is a doji candle. This is a sell to buy. This buy is engulfing. It's at the very extreme. This one, now that we know that we broke the high, we are expecting demand to hold. And we don't want to just take any demand. Now you could. This demand here is decisional, creates push up, but doesn't result in a new high because it's not the very extreme. Remember, the extremes are always going to be way more protected than anything internally. Because if we're making higher highs, we don't want to take out all the liquidity that we built and all the volume created in this zone, because this is the very extreme. The very extreme should hold. Now, if price swept our 15-minute structure and it mitigated something on a lower time frame, we would get taken out if we used the 15. But in most cases, you know, if you use the 4-hour, you're going to be a lot safer because unlikely it will take out the 4-hour. Now we're refining to the 15-minute because the risk to reward is drastically on a completely another level. It's like so much better to trade with the 15-minute. In this case, if you can get a good zone. If you get a bad zone, you're going to be wrong, right? So this 15-minute zone, we come back, price comes in, taps the 4-hour zone. If you were trading the 4-hour long, you would have already been tapped in for your trade. This would have been $850 of stop loss versus the 15-minute zone. That is $180 stop loss. Price comes in, taps, reacts, pushes up, reacts to supply, comes back but respects this demand, and then what do we get? An engulfing candle push up. This is a sell to buy. This is the reaction that creates break of structure. What are we creating now? A new high, 19.7 R. Now, you don't have to take profit on all of these. You could, for example, hold all of these trades until you find price does what? On a 4-hour time frame, changes character to the downside. So for example, knowing on the 4-hour that we have supply all the way up here, or this is, sorry, on the daily time frame, because the daily time frame, you want to target higher time frame levels, right? So if we just came off of a daily supply zone, we respected this level, we got some shorts into here for deeper mitigations, price aggressively reacted, pushed up, we respected this daily demand, what can we expect? Minimum, we'll come back to this daily supply, or we plan to take it out because this demand was responsible for break of structure to the upside. The supply was responsible for break of structure to the downside, but internally it did not take external liquidity because we have what? This extreme and this extreme right up here. So just like the diagram specifically, if we go back to it, look at this. This is exactly what happened here. Strong demand. You can see that we're weakening. Push down. We take internal liquidity. We react. We push back up, but we fail to make a new high. Price comes down, plummeting down. But it what? Respects demand. Demand is strong. We swept liquidity, and then we rallied up. And what? Supply has to fail in this case. So what do we have? We're targeting the supply. In this case, all the entries we took into here, we could have targeted higher. Now, would we target all the way up here? Well, I mean, that'd be kind of wild, right? Because we still have unmitigated demands in here, right, that we'd be targeting too, because this could give us a better reentry, and it did, right? But at the very minimum, let's say, I should probably rewind back here, like this. If we were here, there was no reason why we had to take profit completely here. We could have taken these up and tried to align it to something left. We could look left and see what happened left of here. For example, oops, let me do this. We're going to go like this. Where is this tool? Let's see what happened left that we reacted to that. Let's go on the 1 hour. Look at this. So this was a supply zone that was unmitigated. So, and on the 1 hour, we have a buy, creates a new high, sweeps liquidity to the upside, pushes down. We have a reaction to demand. So price, in this case, the first touch respects demand. So here, we respect demand. We create an extreme. This is a flip. And now we have this supply. And we await to see price come back to tap the equilibrium of this level. So let's say like the 50%. We could just refine it to something like this. Now we look all the way back to the right. And we could have targeted something like that. And now we've improved the risk to reward of these trades, the time we've held them. And you can see price comes in, taps, and respects to the T that level. And that is how we got a really good take profit on all these trades here. Price pushes down. We have to create more demand or more liquidity before we take and run the highs. So that's the last example. Or no, there's one more example. You know, this is a long video. If if you liked this video, definitely I gave you a ton of examples to see what was happening. So this will be the last one. I'm just trying to get the point across that it's very repetitive. Use 4 hour zones, refine to the 15-minute, super clear, right? Let's see what we're looking at here. I already marked it out. So on this case, what are we looking for? Here we made new all-time highs. We took out the supplies to the left, right? So this was supply that we took out. So we swept the highs, but what did we get? We got a reaction that was pretty bearish. Price pushed down. Now what happens here? Are we going to go short because it pushed down? Not necessarily. We want to see what does price react to. In this case, price reacts to this demand. So if this demand holds, why would we take a short until we see a failure of this demand, right? So unless we see a new demand fail. So in this case, what do we have? This high, this low, this new high. Now, what's responsible for creating this new high? You can see in this area, price was ranging quite a bit, accumulating orders. But what do we have here? We have this level that was taken out by what? Look at this. You see this on the 4 hour? On the 4 hour time frame, this is the last demand that pushed price up, swept the highs, and created a new high. After that, what do we have? Price comes back, mitigates this level, continues, and creates a new all-time high. What do we have? Now this demand fails. So now we have a flip zone. Now on the 4 hour, this is what it looks like, but we could refine down, and we probably will. So this is the demand that was responsible for breaking the high. Therefore, this is the one we're looking at. If we're going to continue high, we should respect this level, right? We do respect it, create a new high, but after that, this high taps into something, creates enough liquidity to the downside, enough volume is injected into the market that we sweep these lows. So now let's go on a lower time frame to figure out what happened. Once we see reactions on the 4 hours, we want to go to the 15-minute to see what exactly is going on. Right here. Okay. So now we have this 4-hour zone that we refine down to the 15-minute. This is the 15-minute. Okay. We could even go so far as to do this. This, just like the other examples, a sell to buy with a massive engulfing candle that broke structure to the upside. So that is the origin for this break in structure. What would we want? Typically, we would take a buy from here. Now, you could take a buy from here. In this case, we would be wrong to take the buy. Demand was holding, but we also get an aggressive reaction back to the downside. So price pushes back very aggressively. In this case, if you took the buy, you would have been wrong. But I'm going to show you how to take a wrong trade and flip it and turn it into a winning trade, right? So this demand, what do we have? Price comes in, reacts, creates an extreme, sweeps some liquidity in here, and this is now the buy to sell that makes this demand fail. So this 15-minute demand fails, the 4-hour demand fails, all from this reaction. This is part of the new leg. So I'm going to highlight this area, and I'm going to look to the right and wait to see when price comes back to mitigate it. Because now I know that we broke structure to the downside. You can see how aggressive the push was, right? This is the most extreme that we had at that very moment. So at the minimum, that would be a target. Once price comes in, what do we see here? Price comes in, taps. You could take your entry from here, or you could wait for another reaction to sweep for the first mitigation, but you could have just taken this one safely. And then what we have? Price comes in, once again taps, but also sweeps, but respects this 15-minute supply. And now that we know that on this time frame, on the 15-minute and the 4-hour, that this is a flip zone, we reacted to buys, we sold through that area, the area that created the failure, where the injection of momentum and volume entered was here, and we take this sell. Now the sell, what are we going to target? We are targeting 4-hour levels. Well, we could target what area pushed up here that could fail. So we have this area here. This was the buy, the extreme buy that created this this leg up. When we see an aggressive sell like this occurring, we can expect to come back at least to take out this level, right? And then what can we expect? On the daily time frame, what level do we have? This is our daily level. So this is one massive leg up. Therefore, we could take the long-term opportunity to trade back into this demand zone, because this demand zone was what? Responsible for taking the supply and sweeping the highs, creating new all-time highs. Therefore, what do we have to do? This is a strong demand, and we would like to come back to mitigate it. It's just like this, right? The other part of the picture is back, mitigate, and continuation, right? So then what we have, let's get rid of that. Price came down to a T, came down to tap that zone. And this is what your sell looked like, 1 to 26R, right? And now, did it react to a buy? Not yet, you know. Now we swept this level. and now we're coming back down to here, and now we'll see how price reacts here. But the whole idea behind this is to, when you're trading cryptos, indices, metals, you're trading a long-term appreciating asset. And so the majority of your trade opportunities, like you saw, are going to be buy opportunities. They're going to be the safer ones and the more plentiful trade opportunities. Now, when we're trading, understanding that we have a bullish market, what you're constantly looking for is what? You're waiting to see supply, a strong supply, take price into demand. If that demand holds, you are going to plan to take the buy to take out that supply. So in here on a lower time frame, you would look for this formation of relatively equal lows. You're looking for a sweep. You're going to take the low, you're going to take the high. The high is going to explode with momentum and with volume, as you saw every single time that we had a sell to buy. You saw how massively engulfing that candle was. Then what do we see? Price comes back to mitigate that level and continue. So this is your entry on a lower time frame here. And you're looking for something like that. You're respecting the demand and you're taking out the high. That's your target. Just like that. Same thing with here. When price sweeps or creates a failure of demand, we know the supply is strong, and therefore we are waiting for price to come back to mitigate the supply. And what are we looking for? Something just like this. We are awaiting for creation of liquidity, inducement. We take the high, we take the low, we mitigate, and we continue. This is what it looks like each time. It's just the same thing over and over again. It's not too complicated, relatively simple. And here, just like this. Same thing. We're refining down, and we're now targeting new lows. So I hope that lesson was enjoyable. I hope that you enjoyed the video. I hope you learned a lot. I know this was a long video, but I wanted to get everything into this, and this is how you trade cryptos, indices, and metals. I hope you enjoyed it. Remember, these are what we're looking for, something like this. On a lower time frame, you'll find prices ranging, and when price reacts to these levels, you are awaiting for something like this. On the supplies, you're waiting for a take of the high, take of the low, mitigation, continuation. On the buys, we're looking for a take of the low, take of the high, mitigation, continuation. When we're in ranging markets, we're only targeting the next supply or the next demand. When we are getting failure of one, for example, if we fail the supply, we're looking for continuations entering at demands. If we see that supply is strong and demand is failing, we're looking for continuations of supplies, right? So I hope you enjoyed that video. Have a nice day. See you in the next video.